This session does have about an hour long worth of time, so we've got plenty of time to hit it here. And in fact, there is an implied volatility indicator or like a concept of IV that we can add as a technical indicator. So we'll probably get to that a little bit later on, but just to kind of set an agenda and expectation here moving forward. As always, we do have the uh, calendar and the schedule for our team pulled up here on the screen. So if you need to take a picture or a screenshot of that, then you're golden. It's right there for you for the rest of the week. So, one of the things I'd like to think about here as we start off this session is going to be, who are we as traders? Are we someone who's using fidelity.com? Are we somebody who uses Active Trader Pro? I think for today's demonstration, a lot of what we talk about is going to be on ATP, Active Trader Pro, just because in my experience, both for myself personally, talking to Nick, my other teammates, if you're a technical trader, you're more likely than not going to be on ATP for the real-time information. With that said, if you're someone who uses fidelity.com, this is not in any way to say that you cannot do these things. In fact, funny enough, some of the things on fid.com are actually more advanced than on ATP in terms of certain indicators. So whatever platform you're on, you'll be able to apply these concepts that we talk about here today, but we're probably going to demonstrate most of them through the guise or the lens or the perspective of an ATP user. So just kind of keep that in mind here. So when we think about indicators or volatility or technical analysis, we tend to approach it from an indicator perspective. Before I get too far in the weeds, though, on the smattering of indicators, I'll pass it over to you, Nick, to introduce yourself and maybe your first thoughts about volatility as a technical trader. It's good to see you, though, here on this Monday afternoon, Nick.
Good to see you too, Chase. And for those that aren't aware, we're kind of in the final huzzah with Chase, and so we're going to go out with a bang with that. That said, I do like to set the stage, when it comes to technical analysis, and talk a little bit about that. These indicators they're simply tools, they're calculators and such, and it all comes back to putting together a system to help you get an idea of what the stock has done in the past. Many traders get focused on looking at an indicator and going, well, I found the holy grail, this is the next best thing. Well, it's just a different way of looking at things, and it's no different than looking at a Casio calculator versus Texas Instruments versus an HP, etc. With that, they're just calculators, just tools. Now, some of them have a little bit different functions. I always remember my HP calculator, you have to do like number, enter, number, plus if you wanted to, add two numbers together. So it's just, but they still function the same way, the way you'd add things together or multiply things or divide, or they might have some other specialized functions to give me an idea of what I wanted to see if I wanted to calculate discounted cash flows. I'd use one calculator compared to if I wanted to, graph X squared on a chart, for a graphing calculator. So there's different aspects and different things. So with this as well, I think it's extremely important to talk about the kind of the mathematics behind this, that it is that mathematical tool and such, that everything is based on price and volume. There's not really much else to base it on other than really, are there trades? Where are the trades at? How many trades are at these particular prices and such? That becomes important. That becomes critical. And this kind of gets again into, some of that real heavy Dow theory stuff on this. And there's some differences in calculations between an exponential moving average and a simple moving average. There's differences in calculations as you start to get into volatility indicators about dealing with something like average true range versus historic volatility, with what it's based on and so such. But it's definitely something to think about and to keep in mind as you look at this. And keep in mind that all of these indicators, they're simply tools, and you don't want to miss the forest for the trees. And that becomes really important because many traders that I've worked with, and I'm sure Chase has had the same experience, they get so caught up on, well, which indicator is the best indicator? And there's not a best indicator. You use a trend indicator to help you see, well, where is trend going? Where might it be? Use a momentum indicator to help identify momentum and such to see, well, where might momentum be going, etc., etc. We use volatility to see, where is volatility? Is volatility increasing? Is volatility decreasing? Etc., etc. with that. And so I think it's important to remember that in the grand scheme of things, from that conceptual standpoint, that what's the importance of volatility when we look at indicators. Now, that said, to me, volatility started to become more and more and more important from that pillar of technical analysis standpoint. Really originally, if you talk with Dow, if you could have a conversation with Charles Dow 100 years ago, the the pillars of technical analysis really were trend, momentum, and then volume. And as such, lately, volume has been taking a little bit of a back seat to volatility. And there are a couple of reasons for that. One, a lot of traders they discount volume now because so much trading is done online. I remember placing trades through a broker that was paying a 2% commission to, or something like that, paying literally thousands of dollars to trade 1,000 shares of a $70 stock, and it was negotiated down to about $500 to trade 1 or 2,000 shares of a $70 stock. Then of course I know with Fidelity it went to $50 for online trades, $12.95 for online trades, $7.95, $4.95, and then Fidelity no longer charges for online stock and ETF trades and such. Things have gotten a lot less, and as things have dropped in price with this, there's been more trading, more electronic trading, and because of that, there's more volume, and there's more, maybe superfluous volume, so to speak. And as such, traders they don't quite pay attention to that because it's hard to look at, well, how much of this is investment, people actually going in and holding it for a long period of time like it used to be, versus going in and out, in and out, in and out, in and out, and such, as it builds around these particular technical patterns. So that said, also dealing with volatility indicators, think about the complexity of calculating something like historic volatility, calculating a standard deviation. It's actually pretty easy mathematically to calculate something like a 100-day moving average. And it's a lot easier than you might think. You don't have to add up all 100 numbers of the last 100 days to get today's moving average compared to yesterday's. All you have to do is take a look at what price was 101 days ago, take 100th of that, subtract that from moving average, then take today's price, take 100th of that, add it to the moving average, and boom, it's updated. Easy math. Shift from one day to the next, to the next, to the next, as you continue. Now, if you don't have a basis, you're then adding a lot of numbers and dividing it by 100 to get that. But when it comes to volatility indicators, when it comes to trying to calculate what is the standard deviation, that to me really start to take more of that number crunching that was difficult before the era of having assistance with the calculator, at least for the general person charting prices. So as tools, volatility is starting to become more meaningful, more impactful, and really replace the volume as that main indicator. And so anymore now, many traders, they'll use a trend indicator, a momentum indicator, and now a volatility indicator. I meant to shift over to volatility, not volume. They'll use a volatility indicator to guide their trading decisions. From this, there's a couple different common volatility indicators. And, some of the first ones we have on here, the slides and such, we mentioned Bollinger Bands, but I think it's actually as important to actually take a look at some of the other information that we have on the website. And with this, I'm just going to pull up the Learning Center. And I'm going to show everyone the technical indicator guide. So let me just shift the screen share real quick. And to find the technical indicator guide, simply come over here to topics. And then as we scroll down, advanced trading technical indicator guide, we'll pull that up. And now from here, we can actually scroll down and we can check volatility. Now, a lot of volatility indicators are oscillators. There'll be understudies on the security. They'll go up and go down. They might not be range bound, but think of something like a average true range or historic volatility that you might have seen that can kind of go from zero to a particular level and then kind of back down. It's not quite like a chart where it might trend up and trend down like an on-balance volume and such. You typically have it be something, an understudy below the chart. Now it does on here, it classifies those as indexes or it's kind of indexed on that level, but you typically do get a understudy versus an overlay. Bollinger Bands, of course, is one of the unique ones that it actually does give you that overlay, but I want to start in here. I want to talk about historic volatility first. And the reason being is that I think this kind of sets the ground for some of that knowledge that's important to have as you then build into the Bollinger Bands. So really what this particular indicator does is it takes a look at the last specific period and then it finds standard deviation. Historic volatility is that one standard deviation. Now, this is, of course, annualized. And so you're looking at how much it's moved over a set period of time, but you're then annualizing that. And so if you're looking at a HV20, that's the volatility based on the last 20 trading days. And typically then from the 20 period moving average. And maybe actual volatility is something like 5% is what is deviated from that moving average. Well, then it'll convert that to an annual number, which the annual number might be closer to, 16 or 18%. And then it gets kind of converted back and forth, and so to speak, from that usability standpoint. You can also get a lot of this information. You see some similar things that say traders will use. They might use standard deviation on their chart. They might use Bollinger Band width on their chart, but they're going to get a lot of duplicating information when you start to do that. And so let me just add kind of a quick chart right here. HV, not HV, I'm sorry. We'll look SPY, and we'll come here from an indicator perspective. We'll add HV, historic volatility, and then we'll also add on here Bollinger Band width. We can see a lot of similarities. It's not exact, but we're going to see a lot of these similarities where kind of going up and down at the same time frames with with that. Because dealing with Bollinger Bands, we're looking at how much it's moved in the past, but then charting that based on, shift this over real quick. So we're going to take a look at how much it's moved in the past, then finding that amount, and then adding and subtracting that from the moving average to get that band on there. Now let me add this real quick, indicators, add Bollinger Bands, and you can see, also add up here, simple moving average. You can see that this is plotted from this, but then as the stock has actually moved a lot in the past, starts to move, we get more volatility. It's going to widen those bands up and then narrow and then wider, and so to speak, with that. This kind of then gets into a little bit of that discussion on historic volatility versus implied volatility that you were kind of alluding to earlier, Chase. Is there some other questions that maybe you might want to elaborate on with that, Chase, as we kind of go through some of these indicators? I know you mentioned historic volatility and implied volatility.
Yeah, so what I want to do real quickly here, Nick, is talk a little bit about that just from both a technical perspective, but also for option traders. Let me just shift gears for a moment here. I had some slides up earlier. I was talking to a client today, a one-on-one actually, and her and I were talking about implied volatility. And she was wondering like, well, what makes implied volatility change? So let me do this, Nick. Let me just steal the screen for a moment here. Let me pull up this PowerPoint. I think
Mhm.
personally, this is one of the. Sorry, Nick, what's up?
Go ahead.
Okay,
Sorry,
got it.
I was just agreeing to you grabbing the slide. Sorry.
Oh, no worries. Appreciate that. So I feel this is probably one of the best ways to ever, visualize or show a client how IV works. So I would encourage anybody here with us to take a picture, take a screenshot of this. Um, personally, like when I was brand new to options, I wish I saw something like this when it came to a difficult concept like volatility, specifically implied volatility. So how does it work, right? What leads to higher implied volatility? If we take a step back, what even is IV? Right. The simplest way I can think about this, and Robert Kwan is the one who taught me this language, this verbiage, which is that IV is the mathematical representation of demand for options. In other words, if we kind of peel back that word salad, if the number for IV is higher, demand is higher. If the number goes lower, demand is lower. Right. That's how we can think about this in simplest of terms. So if we imagine if you're a trader or an investor that you're expecting a large move, Nick, I wonder what might cause that. Oh, I don't know, maybe earnings. Do we just happen to have a bunch of earnings coming up this week? I think so, right? So if there's an expected catalyst coming up, clients are thinking to themselves, hey, something might happen here. So what am I going to do? I'm going to buy some options. Why am I going to do that? To either speculate and try to make some money, right? Some buku bucks, let's retire early, or we're going to hedge and manage risk on a position that's already existing that maybe we don't want to sell out of because of tax consequences or something else, right? Ryan has to come with all the money signs. Yet we know which one Ryan is, and no doubt about it. And so if you have all this activity of buying puts, buying calls, doesn't matter which one, for purposes of this conversation, what does that do? Well, folks, let's think about it. Put that kind of econ 101 hat on. If you have all things being equal, but an increase in demand, prices go up, right? We've all seen that. I mean, think about our housing market, right? Supply constraints, more demand. What happens to houses? They increase in value. And we can unwind it to the sort of the post earnings event. So earnings come out, right? Whatever the company might be. Well, after earnings, we're not expecting a whole lot to occur for the next, day, week, month, because the big news just came out. That's what we were hoping for. That's what we were looking for, that binary unknown event. So what happens? Well, people who previously owned their calls and puts are now selling them, maybe to lock in a profit. Maybe they were wrong on direction and volatility, and so they're closing for a loss. But the idea is they're unwinding their trade there's an increase in supply. So you tend to see IV shift significantly. There is a market phenomenon called volatility crush. By a raise of hands, who's heard of this term? Either volatility crush or post earnings crush, earnings crush. There are a bunch of different ways to put it, but we're referring to the same thing, right, Nick? It's the fact that volatility, specifically implied volatility, which again is the mathematical demand of options, that demand of options has been exacerbated and increased and elevated up until earnings. And generally speaking, once the news comes out, you see implied volatility decline. So I bring this up just because if you're on ATP and we're talking about volatility indicators, Nick, let me just shift my gears over now to ATP. I had a chart up earlier. I apologize, but it was kind of lagging on me, so I closed it out here. That's all right. We'll walk through this together. So if we type in SPY, we go to indicators. I've already got ATRP on here, but if I just type in HVIV, notice it's right here, volatility, HV and IVs, vol. And this is going to plot for us both the historical volatility for the past 30 days and then that implied volatility for a roughly 30-day expiration, roughly at the money option rolling forward. So if we take a company, let's switch gears from SPY to like an actual company. Let's take a look at Apple. Let me go to settings. We'll go to earnings here for a moment, which is going to be under events, excuse me. We'll add earnings. And wouldn't you know it here, if we just start taking a look, let's line up some of these earnings announcements. All right, so we've got one about here. We've got one about here as well. And we'll just pick on these two for brevity's sake. Folks, what do we notice about implied volatility, which is on that lower panel? In fact, I'll get rid of average true range for just a minute here. Let's clean this up. What do we notice here about implied volatility leading up to these vertical lines and then shortly after? Right? Leave it in the comments. What do you see? What is obvious? Well, it's obvious to me is that we see this increase in implied volatility a couple weeks or days leading up into it, right? It stagnates a bit. And then right after earnings, that gold line falls through. That's a decrease. What do we see here on the most recent one before the upcoming one here? Again, a rise a couple weeks up before, and then we see volatility crush or decline after. Again, that blue, or excuse me, the gold yellowish line. So that's why I'm bringing it up here in this volatility technical indicator session, is that it's not maybe traditionally seen as a technical indicator, but it's important information that you can put on your chart, especially if you're an options trader. Nick, it's probably good to know, especially with a stock. Let me go ahead and modify this for a moment so we have just the IV on here. It's probably good to know where the upper end of implied volatility tends to be on a name, on a specific stock, right? If we look at Apple, where does this thing tend to peak out at, right? This is the past year. We can go back a little bit further if we need to. So what do we see here? Well, in the past 2 years, let me redraw my line. We can see that a more normal level is somewhere about this 30, 28, 30 level. And during extreme periods of volatility, it's even higher, right? So where are we today from a technical perspective, right? Because we're still doing the same technical analysis that we would normally do, which is look at past information to make future forecasts, not predictions, but forecasts. And we say to ourselves, okay, well, current implied volatility from a technical level, if you will, is very similar to where it's peaked out before. So if you're an options buyer, you might get, hurt badly by implied volatility. If you buy a bunch of options, even if the stock goes in the right direction, remember, you're probably going to see that IV crush, which is going to hurt your options value. Again, I know it's not an options class. I know it's not an IV class. I'm kind of hitting the wave tops here. I apologize if I'm losing anybody, but my point is we can add this as a technical indicator, and it's relatively straightforward for us as traders, right? We're looking at the past and saying, is what is happening today commensurate or similar, I should say, to maybe times in the past? The answer for Apple right now is, yeah, pretty much, right? Coming up into earnings, we have this very strong rally of implied volatility. Again, demand of options increasing. What happens after earnings? Falls off a cliff. Rallies into earnings, falls off a cliff. Up into earnings, falls off a cliff. Here we are today, right? So what would we maybe logically conclude after earnings come out for Apple? What would we expect of implied volatility? Let me know, put it in the comments, right? So even though it's just a line chart, even if you're not an options trader, it's good to recognize that these volatilities in options can certainly still affect the stock. Nick, that was kind of my point that I wanted to make here. Again, I know this isn't a specific options class, but nonetheless, it's an important concept to recognize. Yeah, so China's saying down. Yeah, one would expect that implied volatility is going to drop after earnings. So if you're a technical trader, but you're also an options trader, right? Which many of us are. By raise of hands, who trades options in this class? Just to let me know here. Let me take a look. Yeah, Nick's putting up two hands. Same here, right? If I had a third, I'd raise that too. Um, yeah, my trades are predominantly options. Am I a stock investor? Yeah, sure. I've got a 401k. Nick does too here at Fidelity, but my trades are typically options. So this is important to know. You can still get the price correct and still lose money. If the demand aspect or pricing of the option is sufficiently undermining the price direction. So that's all I wanted to put there. Before I ramble any further on that one, Nick, I guess I'll ask you: is there anything you want to add to the IV conversation specific to? Because I know we can go down that rabbit hole all day. Specific to a technical indicator approach, as I've shown here on the chart.
Couple of things I do want to add, and we'll also want to repeat a little bit what you said is, remember, implied volatility is based on options pricing. And based on option pricing, it's what option traders feel the security is going to do in the next 30 days as far as magnitude of movement. But again, it doesn't care about direction. Could be up, could be down, just magnitude of movement. Similar to historic volatility is just magnitude of movement in the past. How much has it moved in the past? IV is what is the expectations for the future. And I've seen a lot of cases of where option traders expect no movement, and then the company says, "Oh, by the way, we're going to close up shop, or our FDA drug security is killing people, or we have this really great new product," and just it moving a lot, and it was completely unexpected. I've seen cases as well where option traders expect a lot of movement, and then it's a nothing burger, nothing happens. It's based on future projections, but there's no directionality to it. And I really want to stress the no directionality aspect as well, because a lot of traders, a lot of stock only traders, they'll discover some of those option tools and go, "Okay, Nick, how is this going to tell me which way the stock's going to go?" And it doesn't. It doesn't in any way, shape, or form. It just says that, based on options trading, option traders expect more movement in the future, or they expect less movement in the future, etc., etc. Volatility indicators, of course, based on price, based on volume, are simply showing you how much movement has there actually been in the past. Now, there are some differences in calculations and such about these. So there may be a critical difference in calculation when you're looking at, historic volatility is dealing with, historic volatility being based on those percentages of returns and such, percent up, percent down, etc., where those numbers being. Where something like Bollinger Bands being based off of a standard deviation and how much price deviates off of an average, like a 20-period moving average. And that's why we have some of those differences between, what historic volatility looks like versus, what standard deviation looks like. And a lot of option traders, they'll tend to use historic volatility because of those return-based characteristics of the past, and they're then forward-looking with future volatility expectations. And maybe dropping a little bit of a knowledge clip here, you have historic volatility. It's historically what the security's done. Implied volatility is volatility implied off option trading. Chase, did you want to add something to that? I saw you came off of mute.
Oh, sorry, Nick. Yeah, I was going to add one thing is that when you're looking at this indicator, like when you add it as such, so when you search for indicators, again, real quick for folks, it's IVHV, or HVIV, I should say, right here. When what I've done though, I thought I saw a comment about the difference between them diverging. You can modify this as well, so you can change by clicking on the bubble, choose modify. It's going to default to showing the implied volatility for a 30-day expiration option and the HV for the past 30 days. I just simply unchecked it just so there's less distraction here for us as a group. I know many traders who don't ever use the HV function of it. They're concerned with the IV specifically, but you could use this however you want, right? All these indicators have their pros and cons in terms of how you adjust them. All right, Nick, that's all I had on the IV thing. I don't want to derail us too much, but I just thought that was interesting here from a tidbit perspective for an indicator that I think most people don't really talk about out in the industry and certainly here at Fidelity. Do you want to hop into maybe some more of the traditional ones? Like I was thinking about going to average to range. Do you have any issues if we hop into ATR for a little bit?
Why don't we jump into and address Bollinger Bands first, since
Okay,
I know you
let's
have
do it.
Bollinger Bands on the chart. Can you
Okay.
simply add Bollinger Band width to us?
Yeah, let's do it up.
Because I think this actually highlights a very valuable, very useful thing with Bollinger Bands. So one of the big things that traders will look at with Bollinger Bands is them expanding and them tightening. And actually seeing Bollinger Band width as an understudy helps draw our attention to this. And so when you see the bands contract, traders will frequently look for price to break out, up or down. Now we have, an example here, most recently where there's a big upside breakout. You kind of see it contracting, 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 going sideways, and then boom, moved up a lot. Two big green bars in a row in the June timeframe. That was an upside breakout. There are plenty that we've seen some of these downside breakouts with, and you're looking at end of December, January is another example where Bollinger Bands were narrower, and then it broke out to the downside. So that's one of the big ways that Bollinger Bands are utilized, is to take a look at and see when are they squeezing together, when are they moving apart. As traders look for that narrowing band to be, prices kind of consolidating and then to move one direction or the other. And again, that doesn't, just like we're talking about volatility, vol just like we're talking about implied volatility doesn't really care what direction it moves from that standpoint. Now, another way of Bollinger Bands are utilized is in dealing when price then exceeds the band one way or the other. And right where Chase's mouse is, it shows a great example of when price exceeded the band to the upside. This shows a lot of strength, mathematically extending the price. Shows that strength. And Chase is kind of shifting over the opacity of the bands to really hide price, so we can just see the points of where it's expanding either above or below the band. So there are a couple ways that traders might utilize the Bollinger Bands as a trading system as well. You get asked these questions a lot. Well, how can I kind of use these as a trading system? And one of the big things is that when price exceeds above the band, that's a show of strength. That's a bullish signal. You'd want to buy. When price drops below the band, that's a weakness signal. You'd want to sell. Those are the two big signals with that. Of course, price going back into the band kind of invalidates these signals, which then gives a couple different ways that this could be traded. First is that some traders, when they see it exceed the band, that's when they'll enter. And they see it go beyond the band on the other side, that's when they'll flip their trade. I'm saying flip their trade versus exit because they'll quite literally see it exceed above the top side, they'll go long. They'll see it exceed below the bottom side, and they'll close their long and go short an equal amount of shares. They'll see it go above the top side, close or short, and go long. They're either long or short. They're always in the market. Other traders, they might be long biased, and they might simply purchase when it exceeds the band and then close their long position when it exceeds the band on the bottom side. So one way of looking at it. Second way is like I mentioned about that weakness aspect, kind of invalidating it a little bit. They'll see it exceed the band. That's when they'll buy. But when it re-enters the band, they'll close out. Whether it's buy, close out, short, close out, it's the same thing with that. So there's two big ways the bands are utilized. A third way, and this involves the same entering when price exceeds the band, is when it crosses the 20 period moving average for this regular Bollinger Band. That's then when they exit, just like you might with a normal trend. And so they'll buy when it exceeds the band. So like if you look at Apple with that earnings flag where it leaped up, that might have then been a buy. And then somebody would have stayed in Apple until it dropped below the 20 period moving average there. And you could look at maybe 2 weeks before Apple had that earnings, it exceeded the band on the bottom side. They might have sold short, but they covered their short when price came up above the 20 period moving average. So there's your third way. First is enter and then exit when it goes back in the band. The second is enter and then wait for it to go all the way across the band and then exit. And then the third is, enter and then wait for it to break the 20 period moving average before you exit. This also doesn't have to be an all or none kind of thing. You could enter and then close a third of your position out when it goes back in the band. Close another third when it goes below the 20 period moving average and close the last bit when it actually goes beyond the other side. You could also step into positions like that as well. I know traders, they might purchase, when a security goes above or below a moving average, but you then could add on to it as it goes above the band. And so maybe you might have 50% when it goes above the moving average, and then another 50% when it goes above the band. And then the exits could be similar, where either you do a third, or some traders, they might 50% when it goes, exit 50% when it goes below the moving average, and then exit the last bit if it goes beyond the band on the other side. So a lot of different ways you leverage the bands for entry, exit criteria. And that again is also combining it with entry, exit criteria with the way you might use moving averages. Chase, I saw you came off of mute there. Was there a question that you wanted to elaborate on, or another point you wanted to make?
Yeah, something else I wanted to add is that this is the default setting for the Bollinger Band, which is, again, if we click on this, we choose modify, it's going to be based on a 2 standard deviation envelope, and it's based off a 20 period moving average. Remember, though, if you're a shorter term trader or maybe even a longer term trader, you might augment this. Now, I'm not saying that you should just go in here and willy-nilly change things around, but if you have a specific purpose for it, that's completely valid. Nick, I bring it up because there's intraday traders I've spoken to, and they'll trade in the very shorter term. So let me go to an extended hours intraday chart, and I'll stick it to, let's say, a 5-minute frequency. And we'll go to like a 2-day chart. I was talking to a trader who what they'll do is they'll use the Bollinger Bands, but they'll use a 1 standard deviation. The idea being is that most of the time, or at least a third of the time, you'd expect that, or 2/3, excuse me, of the time, you'd expect for information to kind of be there. And you say to yourself, okay, well, if that's the case, then when it breaks out, it's going to be more meaningful. But if they wait for a 2 standard deviation, they're never going to get a signal, or by the time they do, it's at the extremes. So that's kind of an interesting way to look at it. So if I change this to a 1 standard deviation, we take a look at this. We'll go to, let's see, like right about here. The way that they'll use a system like this in the short term is when this breaks through, that's kind of your initial signal. And as it starts to re-enter the bubble or re-enter the envelope, that would be an exit. So again, you're entering here as a show of strength. And during the strong trends, it would ride up and above this Bollinger Band. and as it re-enters, you close. Now, notice it's relatively similar to a 5-day SMA system as well, or a 5-period SMA. This is a 5-minute chart. So I've seen people kind of go back and forth between the two of them. I've also seen them
Mm.
supplement it where they might use a 20-period 5-minute with the 1 standard deviation Bollinger Band. The idea being is from a scaling perspective, they first enter if the stock or ETF, whatever it is, goes above the 5-period, or excuse me, the 20-period on the 5-minute. And then they get their confidence and confirmation if it maintains above the Bollinger Band. And as it re-enters, that's when they start to scale out of the position. So again, there's multiple ways to use this. It's really
Yeah,
just a tool. So whether you're using a hammer or a screwdriver, right, or a chainsaw, you can use those tools to do a lot of different jobs, right? The idea is you just don't want to cut your arm off, right? You want to use the tool appropriately to the best of your ability, but they've got some flexibility. So you could customize the Bollinger Band to a 1 standard deviation. You probably get more breakout signals. But Nick, as you taught me many, many years ago, it's a balance between relevance versus reliability. So do you want more
yeah.
signals that maybe give you more whipsaw? If you're an intraday trader, you probably do want more signals. You're looking for trades, right? But if you're a longer or intermediate term trader, you're probably okay with just the more significant signal. So it's a balancing act, nonetheless.
On
Nick, I'd
this,
love to,
I do want to add one more thing before we move off of this
yeah,
this chart. Talking about modification. Once you really understand what these tools, what these calculators are showing you, how they work, then is when you can start to modify these, like what Chase was saying, shorter term basis, taking it down to 1 standard deviation. Something else I'll see traders might do is go ahead and go back to the Bollinger Band settings, and let's change this as opposed to 20 and 2, make it 50 and 2.5. So, first off, it's going to be a little bit less reactive because it's the 50, a little bit wider the 2.5. They might do it based on something like this, where they'll base it off of the 50-period moving average as opposed to 20, looking for longer term aspects. And again, a little bit more on that. Or they might kind of reduce things a little bit as well, whether it's on like a 1.5 and such. There are a lot of different ways that you can tailor things down to get what you want to see. And like Chase mentioned, it's a trade-off between relevance and reliability.
yeah, no doubt, Nick. Do you want to switch gears now? We'll take a look at average to range, both the nominal and percentage. I think we can hop into that a little bit more detail. Um, so let me get rid of the BBW down here, the Bollinger Bands width, and then we'll get rid of actually, we'll leave them on the screen for now. That's fine for the overlay. So this next one is actually one of my favorites. This is the average true range. Now you might say, well, Chase, does it being your favorite make it better? No, no. The reason I like it and why I say it's my favorite is it's very specific in its use. It's applicable. It's not really nebulous of any way. It's a simple number. So let me explain myself. Average true range in its simplest of terms is going to represent and reveal to you the average movement up or down over some period of time. Okay. So the way that we read this is an average true range of 14 is looking at the past 14 periods. So if I zoom in here, this is a 14-day average, right? This is a daily frequency. This is NVIDIA, and it shows as 5.79. So what that means to us, how we interpret this as a trader, is that on average, and you say, well, Chase, on average of what? Over the past 14 data points, the stock has moved up or down. Again, Nick, I love that you point this out. Most of these volatility measures are not directionally biased. So it's not going to say always up or always down. But on average, it's moved about $5.79 per day. That's what this is. Now, folks, does this tell us what tomorrow is going to be? Nope, it doesn't, right? It's still historical. But I like it because it gives us some context. Let's say you're a trader and you're thinking to yourself, I see this short-term downtrend, but I'm thinking that it's going to bounce. Why am I thinking that? Well, maybe I'm looking at the end of the Bollinger Band, okay? Or maybe I'm thinking it's just oversold. Now, I'd argue if you're a trend trader, you're probably looking at this thing, yeah, that's a bit dangerous. But let's just assume you're looking to make an entry. Where's your risk management? When are you going to close? Well, you can start to use ATR and say, well, from a volatility perspective, if tomorrow is a down day, and it's down on the average size. In other words, it's not a massive day, it's not a small day, it's just an average day. I could expect this to be down $5.79. Now, is that going to happen? We don't know, but we're starting to create that forecast and create that plan. Christine, yeah, one more time. No problem whatsoever. Average true range is going to reveal to you the average movement up or down for a stock on a daily basis. The average daily movement. So the average for NVIDIA is it's moving up or down $5.79 a day. Okay. Now I say daily, it's based on your frequency. So if I change this to weekly, then it would be on a weekly basis, right? So it is frequency dependent, just like really every other technical indicator out there. So yeah, if tomorrow's a down day, folks, we could say, well, listen, okay, I'm gonna rent to $6. I just go $6 lower, give or take. And if it's a down day, we could be right down here. Good to know. If I'm an options trader, well, how much movement of that $5, $6 movement relative to my delta is going to help or hurt my position, for example, right? If you're looking for a stop loss, where do I put one? Maybe where average true range would be for one day or maybe 2 days. Very common for traders to use a multiple of ATR. So as opposed to just one day, I mean, that might be relatively quick. What if you want 2 days? Okay, then you start to put it further. But 2 days is almost 11. It's more than $11 away. Well, $11 from $111 stock, is that really reasonable from a risk perspective? Maybe, maybe not. That's why I like using this though. Also, we can see that during this uptrend that has recently stalled and started to reverse, notice that the volatility on a daily basis has increased. That's not very common for very strong, consistent uptrends. Now it can be, but, it's kind of a trick point that I'm making here. Has it really increased? Good question. This brings us to the next section. Average true range percentage. Okay, now here's why we do this. If NVIDIA is a $40 stock back here and it's moving a couple dollars per day, as a percentage, that can be significant. If it's a $100 stock and it's only moving a few bucks, it's much less significant as a percentage. So the dollars and cents, the nominal version, still good, no problems with it. But I often like to complement or maybe supplement with the percentage version of it as well. So has volatility increased? Yes, it still has. We can see that as a percentage basis. But how about this period of time? Did it increase? It did to a degree. It also had a decrease as well here, right? I like the percentage though, because it gives us a way to measure apple to apple. So let me take a step back. What is this showing us? This is showing us the average daily movement of NVIDIA up or down as a percent. So it's moving about 5% per day. Could that change? Yes. Will it change? Most likely, unless it stays absolutely consistent, but trends are going to change through time. Right, Nick? So we know that right now it's moving about 5% per day. Well, just a couple of weeks ago, it was moving 3.5% per day. So volatility has increased. Again, this is good to know if you're looking to set a stop loss and your stop loss is 1% away from price. Listen, folks, the average day is 5%. So you could almost expect to be stopped out, right? Just within reason. Doesn't guarantee the next day is going to be a 5% day. It just means if tomorrow is an average day, we can start to build some forecasts. The other reason I like this, Nick, is because it's a percentage, right? Standardized. Now we can compare across securities, right? So if I go back to SPY, SPY is moving $6 a day. Wow, that's more than NVIDIA. Well, hold on, not necessarily. It's moving $6, but of a $500+ stock. So it's actually moving as a percentage about 1% per day, right? That's a fifth of NVIDIA. But if you look at just the nominal version, you're thinking, wow, SPY is more volatile than NVIDIA. Does that make sense, right? No, it doesn't make sense. That's why we have to put it in percentage terms. So you can use this as a way to measure what stocks you're looking at or what ETFs are volatile, not volatile, the level of volatility, if it's increased, which we have seen that it has, and then from like a trading system perspective, you can then leverage it and say, well, if I know it's moving this amount and I forecast that to continue, I can build some plans that are, reasonable.
Something I like about average true range percent, and I know you mentioned NVIDIA. So Chase, could you actually pull up NVIDIA for us and take us to a 5-year chart? We look at average true range on that left side, and it just looks flat. or average true range percent, we can actually see some information. And I think Tesla does this as well over the last 5 years. That's just looking at average true range, we're not really seeing much information. It looks like it's just simply flat. And then we look at average range percent and we see that nothing really has changed. And that it might have been Tesla about 2 years ago. And so if you expand Tesla to 5 years, 10 years versus the 5 year mark, we can see that left side of the chart, it's pretty much flat, where other than the spike due to COVID on a percentage basis, there are a couple additional time frames when Tesla did move a little bit more, but it's pretty much done the same thing from a movement perspective over the last 10 years. Average true range, I think, is a very, very useful tool when you're trying to standardize your expectations of movement across a couple different securities. The excuse me.
Bless you.
Um, the and we can shift back over to maybe like a 1 year, 2 year basis. I like to point out with Tesla, we have an average true range percent of, close to 6% right now. And it swings low at about 4%. So if you're to set a stop loss, and this is where I really like using average true ranges for stop losses. If you set a 5% stop loss, you're going to get stopped out any given day. Potentially if the low of the day is after the high of the day, you're going to get stopped out. Even if it goes high of the day, low of the day, and comes back and closes back towards that high, you're going to get stopped out. Where if we shift over and we look at something like SPY, that is a much lower average true range, under 1%, or right about that, 1.2% now. That now we can do something where it's you actually did IWM versus SPY. The we can see that shift where we can do 2 times ATR, 3 times ATR, and still be 5%. And so you really have to have a big day with SPY for it to shift things 5%, so to speak. And so with that, some traders, they might say, okay, if it goes 2 times average true range, or about 2.5% on SPY, well, then I'm going to get stopped out, where 2 average true range on Tesla is 10%. And we shift over, and if we look at Microsoft or Apple or something like that instead, it's not going to be as low as the S&P 500, closer to 2% versus the 1.2%, but not as high as Tesla was. And so we can keep this with our system of it being a multiple of average true range versus looking at going, well, if you just pick 5%, 5% is a big move with the S&P 500, but 5% is a daily move with Tesla.
Exactly, Nick. That's why I say it's my favorite, or one of my favorites from a volatility perspective. It really, I think, gives you, the trader, an appreciation of what you're getting yourself into, right? Because we'll look at the chart sometimes, we see the candles, and we're like, yeah, these look a little bit bigger than these, but you start to put it in context and go, wait a second, we're in a paradigm or a relationship in which, um, for a while now, we've been around 4 or 5%, but just a year or beginning of this year, we're down like the 2%. So right now we're experiencing twice the volatility if I enter a trade today versus at the beginning of the year. And again, it's not always the case, but generally speaking, during the very strongest of uptrends, you don't see like massive increases in volatility. Now that can happen just as a subsequent or as a byproduct of the price increasing as well. But like the strongest, smoothest of uptrends don't see a ton of volatility. So if you're in an uptrend, aka, and all of a sudden you start to see this volatility rear its head, that's a signal. Like, is that really the strongest of trend? Because the strongest trends are smooth sailing. But now we're hitting choppy waters. So something's going on here underneath the surface. It should be noteworthy. Russell saying, can you set a trailing stop loss based on average true range percentage? Excuse me. So not technically, Russell, no. So if you go to like a trade, for example, we'll go to SPY, no problem there. Sell, order, let's say trailing stop loss by percentage. This is still going to be a like a linear percentage. It's not going to be based on average true range itself, but you could then use that to inform your opinion. Yes. So it's not like directly linked to it, but you could say, hey, if an average day for NVIDIA is 5%, then I'll kind of use that as my starting point. Like if I use a 1 times average true range, I'll just put in 5%, right? But just know that moving forward, you might be, you know, stopped out like same day or maybe the next day. So that's what Nick was talking about, like the multiples concept. So you might say, well, if one day is 5%, then I want a 2 day gap, assuming 2 days in a row we're down, and each day is of average size. If that's the case, then with NVIDIA, that's like a 10% decline. So you might set your strong stop loss at 10% for a 2 times average true range. Russell, I hope that answers your question. I hope I didn't lose you there in the math. I know it's kind of it can be it can be complex. So to answer your question, yes, you can set your stop loss based on ATRP. That won't happen automatically. You can't like click a button to sync it to it. You're sort of mentally and manually doing that yourself, if that makes sense. Hopefully I didn't lose you there. But that's why I like it because it gives you a specific use case. Like Bollinger Bands is okay, but like where's my number? Like where do I set this? Right? It's sometimes not as applicable, I think, from a trader's perspective when it comes to managing risk. So just kind of keep that in mind. And of course, everything I've talked about at this point is a daily frequency. So when I was asked by a couple clients, like, hey, can you explain it? I'm explaining it as the average daily movement up or down. Remember, folks, that frequency is going to be crucial when it comes to your technical indicators. If I change it to weekly, everything we said still applies, but it's just a weekly time frame. So now the weekly movement in NVIDIA up or down is about 9%. Okay, good to know. How about SPY? We'll go back to the broader base indices, about 2%. So even on a weekly basis, NVIDIA is still about 5 times as volatile as the S&P 500, right? But definitely good to know. Notice that, again, as we're going through this let me zoom out a little bit further here, Nick. Let's go to a 5-year chart. Folks, do you see what I'm saying? How like during a very strong uptrend, look, what's happening with volatility? It's not increasing, right? It's actually decreasing. That's really like the strongest of trends have decreasing volatility matching with increasing. Sorry, let me take a step back. In a bullish trend, you'd expect decreasing volatility with bullish price movement. It's the opposite with the strongest bear trends, which are often in our marketplaces short-lived. It's sort of like a common market mechanic where we call it stairs up, elevator down, right? But during an elevator down, volatility does what? It goes all the way up, right? It goes up a lot. As we have a strong trend, it starts to subside. Volatility starts to rear its head again. Volatility increases. As you start to see a decrease, all right, you can kind of see where it goes from here. One other note that I see traders will do, again, I'm going to keep it on weekly, but you could do this on a daily perspective as well, is if I click add indicator, I can actually add a simple moving average to my average true range percentage. Not trying to lose anybody here, but we're essentially smoothing out the peaks and the troughs here in the data. And you can use this almost like a signal line for an additional layer of confirmation. So Nick, super simple. It might look something like, hey, if price action breaks above my moving average, that's my initial impetus to place a trade. So I'm going to start slow, maybe enter a quarter of my total position holding that I want, right? So if I want to hold 100 shares, I'll just buy 25 because it could reverse. I don't have a lot of confirmation. We'll see what happens. Okay, then it breaks above the Bollinger Bands. Hey, that's pretty good. I'll buy another 50 or 25 shares. So now I'm at my 50% holding. It tucks back, but it hasn't closed beneath it. It's holding. Oh, it makes a new high relative to the recent reversal point. There's my next 25. What's my last confirmation signal? Because remember, I purchased early here with elevated levels of volatility. Oh, wait a second. Volatility has crossed its signal line, aka the moving average, and it's now below average. Maybe that's my next impetus and level of confirmation to place a trade, right? Okay, well, where's my first warning sign? We're right about here. Notice that volatility, both from let me take a step back. Your first warning sign and major warning signs from price itself reversing off the top end and testing your moving average, which hadn't happened for months. In addition, that's coinciding with a crossover of its average of volatility. So you've got price action getting kind of sketchy, volatility starting to pick up, and wouldn't you know it, in this case, volatility kind of leads the way here. Trend is holding, but we're seeing some chop. Then we break underneath this trend and notice that former support becomes resistance. Once, twice, three times you're sold, brings off or brings upon a relatively strong sell off there in 2022. So again, multiple ways to do this. This isn't like the way to do it, right, folks? As anytime we're talking about technical indicators, this isn't the way. This is a way. But I do find it useful when you're looking at it. You add that kind of signal line to let you know, is something changing, or is this kind of normal or to be expected? All right, Nick, I know we're basically at time here. So let me do this though. I don't have anything directly after this. I'm going to stay maybe 5 minutes late to answer these questions because there's a few here in the hopper. So let's just go through these real quickly here. Um, so Anonymous saying, are Bollinger Bands on the right setting? Yeah, good question. I love the attention to detail. They're not on the right or kind of default setting. So if I click on this, I go back to modify. I still had it all skewed up the way that Nick had me just kind of quickly show how you can modify this. So if I go back to 20, and we'll make this back to a 2 standard deviation Bollinger Band, we can take a look. Does this picture change? Yes and no. It's exactly what you'd expect it to be, which is that price is riding in between almost what we refer to as the guardrails of volatility, aka it's kind of stuck underneath its 2 standard deviation Bollinger Band, but above its 20 period moving average. Very common for a strong trend, both bear or bull, to kind of ping pong between these guardrails. Again, got kind of sketchy here. And then once it broke through, that's your major confirmation from a price perspective. And then, of course, volatility is also confirming it. So yeah, great catch. Of the Bollinger Bands were not on their default setting at that point when I was first showing the chart, no doubt about it. Um, Someone, I'm not sure if it's the same anonymous. I can't tell if there's multiple in here. It says, please explain Bollinger Band concept again. Um, Nick, I've been talking for a while. Do you want to tackle this? You know, in my simplest of terms, it's just simply looking at a volatility of price based upon an average. But I'll let you tackle that one, Nick, if you don't mind.
So Bollinger Bands, of course, they're based off of a standard deviation. So it's a very, very similar calculation to historic volatility, with the exception of as opposed to being like percent returns, it's looking at that value that it is above or below the moving average. And as such, you'll get some variances in it because of that. So Bollinger Bands, you have your moving average, you have the deviation above or below that, and then it's going to it's going to graph those particular lines. So one common thing I've also seen traders will do is they'll have the Bollinger Bands on there, but they'll turn the opacity down, where the opacity might be 0. And then what they also might do is the line thickness, they might actually make it dotted lines versus them being solid lines. That way they're more ethereal there on your chart, where you can kind of see those levels, as opposed to it being quite so bold and visible. Just as a little guidelines to let you know where those are. But the big way, and I've seen Bollinger Bands used as well, is looking to see where just you see the price squeezing. And a couple spots that jump out to me, one, we take it back to maybe a 2-year basis, or I'll do back on that 5-year weekly basis. We can use the weekly basis here instead. Is looks like price is squeezing between the January 23 and the July 23. Just the bands are squeezing down, and it kind of starts to ride the top of that band. That might have been a scenario where traders looking to see the band squeezing and then that expansion. But traders looking to see when the bands are squeezing, because you see it again on the very far left-hand side, the band squeezed again, then erode the top, it started to expand, then boom, it dropped. So you don't really know whether this is going to be an up or a down with this. This is separate, of course, from looking at it from the perspective of entering a trade when it goes beyond the band, that's showing strength or a weakness with that. I kind of think about it, some of the differences on, like, if you're using RSI. One of your signals for RSI is when it leaves the overbought oversold. When RSI was at 73 and now at 68, that's a bearish signal. When RSI was 28 and then it's 33, that's a bullish signal. That's kind of like price going above or below the bands. But the band squeezing is more like looking at divergences, where you're seeing price making higher highs but RSI not, or price making lower lows but RSI not making lower lows. That's kind of where a little bit of that equivalent aspect with that there. Anything else that you might want to elaborate on with that, Chase, or any other questions we can touch on?
Yeah, the question that came through was where'd it go? Sorry, here I was trying to close one out. Okay, yeah. What are the time frame from? Like, is it based on days or whatnot? So this is for Igor. I apologize if I'm butchering that. Please forgive me. Um, so remember, any of these indicators are based on the frequency down below. So this is a 20 period Bollinger Band. That's the default setting. But then the question becomes, what periods are we using? Well, we're using a weekly period. So right now, this is a 20-week Bollinger Band. If I switch back to, let's say, a 6-month chart on a daily basis, now it is going to be a 20-day Bollinger Band. If you're ever confused as well, a good little cheat is to add a moving average and have the period of the moving average match your Bollinger Band. So here's a 20
Mm-hmm.
day moving average with a 20 day Bollinger Band, and it's always going to be in the center of the band because by definition, that's what it's trying to do. It's looking at two standard deviations from this average. So I hope that helps.
You,
But
you
yeah,
you don't need to have that. I know some
you
traders
don't
will
need
have
it.
Bollinger Bands but not use the 20-period moving average,
No doubt about it.
or they might have Bollinger Bands but then have like the 13 and 26 EMAs because they're MACD aficionados. But I'm always a big fan of if you have the bands to have the midline of that. So if you're using if you're basing it off of a 50, use the 50. If you're basing it off of a 10, use the 10. Using default 20, use 20.
Agreed. Agreed. Next question that came through. This is from Miroslava, if I'm saying that correctly. Bollinger Band, one standard deviation, 5 SMA. Can you explain how to trade? Yeah, so I kind of commented on this briefly, and maybe this is what you're referring to from previous conversation here. So I got SPY pulled up. One of the ways I was just trying to show is with a short-term trader, they might use a one period, or excuse me, a one standard deviation Bollinger Band. Now you can change the period if you want. I left it as 20, and then I'm also using a 20 period moving average. Again, as Nick was just kind of commenting, I tend to keep the same period of a moving average with a Bollinger Band. You don't always have to. That's totally fine. But in this kind of system, it's again more of a layering of confirmation effect. So if the stock breaks up and above the moving average, that might be your first indication to buy. If it gets above the Bollinger Band, that's your second indication to buy. As long as it maintains, let's say, your moving average, you're still going to hold. You start to see the rally, which you appreciate. And then once it tucks back in, you're going to use that upper band as almost like a partial stop loss. Like, oh, hey, listen, before things get really bad, right? I don't want to wait for the full confirmation. I'll start to take some chips off the table as it re-enters the band. So that's a very common way to do this from like a short-term perspective. Could you honestly just use a slower moving average and get some kind of similar effect or a tighter moving average? You probably could. You probably could. But that's just one way to think about it. Again, why the one standard deviation Bollinger Band? Well, because if you made the two standard deviation on an intraday basis, you may not get many signals because by definition, most of the data would be stuck inside the two standard deviation band, right? And the whole point is you're looking for it to break out of the band because that would be to you as a trader a significant signal, like something warranting an intraday trade. That's why we're changing it from a 2 to a 1. You want more signals. You want to be notified when there's a meaningful intraday trend that's occurring, right? And again, like in the strongest of trends, you'd see that the price rides the band. And as that trend starts to weaken, it's going to re-enter. So very strong intraday uptrend kind of rides it almost as if it's its own moving average, if you will. And then as it starts to falter, it breaks down, re-enters. Strong bearish downtrend, falters, breaks back up, right? And that's on SPY, like any system, like any indicator. You might want to start like back testing this by looking at some charts and just see based on history what does this look like for you? If you're trading something that doesn't move significantly in either direction, it's kind of like a sideways chopper, this might not help at all, right? It just depends. But here's a good example of the other day. Underneath its moving average, underneath this Bollinger Band, see how it almost like a magnet gets sucked up to the band. Very, very strong downtrend. Oh, it's starting to wane a little bit. It re-entered it once. Okay, here's a new low intraday. Okay, but oh, this is almost the same level. It's still a little bit lower, but not quite. And you can kind of see how this is starting to play out here, where these lows are getting technically lower, but the difference between each low is less and less. Now we're starting to flatten out. We re-enter the band, and right there, the bear trade on the short term's over. What happens? Intraday double top, and then the same sequence over again, right? And so you can kind of use that system. I'm being long-winded, but that's an example of how you could do that. Looking through here as well. Alan's saying, could you use the Bollinger Band to use or to generate an idea of expected move? I don't know about that one, Nick. I'd be curious on your thoughts. That's not typically how I've ever used it. I'm
I,
sure
I'll,
you
I'll be
could.
I'll be extremely blunt. Technical analysis is descriptive of the past. It's
Yeah.
helping us to look at what stock price has done in the past. It is not predictive of the future.
Right, but Nick, hear me out
It just,
from a
yeah,
forecast perspective. Just like with ATRP, right? ATRP is not going to predict the future volatility, but we're kind of using it from a forecasting perspective. Have you
yeah.
ever seen someone use Bollinger Bands for forecast? I personally haven't. Like when it
The
comes to a trade thesis.
the only thing I would look at it from is the perspective that, Bollinger Bands, you're looking at two standard deviations. And so I would then forecast based off that 95% of prices you see should be within the bands.
Hmm.
And
Yeah,
so
I guess from a yeah, that's a good point, Nick. I,
that's
I
that's
think
that's
from
the
a
biggest, yeah, the biggest thing I would look at is that, going forward, it should be within the bands 95%.
Yeah, you bring up a good point here. Again, I know we're wrapping up, folks, but I don't mind staying late. I've only got a few sessions left on this desk anyway, so um, I have seen from like a mean reversion perspective, traders may be thinking about that. Like, hey, here's the volatility index, right? Here's VIX. Let me make the Bollinger Bands just a little bit more apparent here to make this point. So we'll go back to a line. And they might say, hey, listen, if volatility breaks out of the two standard deviation, that's significant to me. That might be a point in time where I'm looking for a volatility mean reversion type trade. Those can be
Yeah.
complex. By no means is that a beginner type trade. There's many ways to go about it as well. I've even seen traders use a three standard deviation as well. You might say, Chase, three, what is that like? If I remember, Nick, correct me if I'm wrong, it's like 99.7, I think is what it is, or 99.5, something like that, for the three standard deviation. It's significant,
It's
right?
yeah, yeah, it's like
Most
yeah,
data,
90, yeah,
or like maybe
99 point like 7, 99.8,
99.97.
yeah.
Yeah, I'm sure someone can Google search as I'm talking and fact check me, right? The beauty of the internet. My point being here is that only in the biggest spikes do you get a breakout of this level. And not just big, but quick. That's the difference. Like if it's a slow but big move, it may not break above it. But if it's a quick, sharp move, then you certainly may. You certainly may. Easy ways to modify this: max out the opacity so you only see the breakouts, if you will. And notice here, it breaks out here, reverts, breaks out here, reverts, breaks out here, kind of reverts, but doesn't. Okay, so there's some limitations here. How about here? Kind of volatility chop sideways. Here it worked. Here, maybe in the short term, but came right back up. Here, yep, mean reverted. Right here, mean reverted. Here, kind of. So again, not foolproof, but I would say from a forecast perspective, um, Alan, to your question of like, could Bollinger Bands be used to get an idea of expected move? Maybe not in stocks the way I would traditionally think about it, but from a volatility perspective, people might use it for mean reversion. Like, hey, this thing's moved so fast, so big, so soon. Volatility kind of has to revert or has to tuck in. So that's food for thought. Um, Different way to approach that question, but it's an answer nonetheless.
Yeah, that kind of
Um,
goes back to that it exceeds the band entry, and if it comes back into it,
yeah.
closing it out.
So I'm looking through here. All right, we answered Russell's question. So Michael says, and this is kind of a longer one, if stock is going sideways and you buy when it goes above the band and sell when it goes below Bollinger Band, you would generally make a loss, wouldn't you? So the overall direction of, yeah, great question. So let's go to this for a moment here. And hopefully you're still with us here, Michael. Apologize, we're just getting to the question here. So let's make this a 2. Let's go back to kind of our mean or sort of standard settings. So the idea being, and actually I'm going to pick on something else. Let's use the Russell IWM. So the question being, well, hey, if you're in like a sideways chop and you're using that system, wouldn't you get a lot of signals and maybe some losses? The answer is yeah, potentially. Because remember, the Bollinger Bands are following a moving average. In this case, the default setting is a 20-period moving average. So just like if you're using a 20-period moving average itself through whipsaw, and you're going to have a bunch of losses accumulate potentially, the Bollinger Band system might lead to a very similar fate. Okay, so that's actually a great point there, Michael. Again, this is why when we talk about volatility, remember the pillars of technical analysis, we teach it in this order for a reason. It's well, price itself, of course, but the trend of price, momentum of price, and then we supplement with volatility and volume. If we're not recognizing trend first, I mean, it's kind of the blind leading the blind, right? Hey, strong uptrend. Okay, be mindful of that. I'd expect it to ride between the bands. Oh, sideways trend. I don't know if I want to be in that, even with the Bollinger Band confirmation system, because I might be subjected to a lot of chop, a lot of sideways volatility, right? So definitely a good point. I'm glad that you said that. Thank you. Um, so yeah, folks, and Nick, I think you made this point earlier. Don't miss the forest for the trees, right? We're still, if we're truly technical traders, we're still trend trading first, supplementing with momentum, volume, volatility, right? So we're kind of adding this volatility layer to our analysis. Um, yeah, don't miss the forest for the trees. I love that. And then I'm looking through here. We've basically wrapped up the questions, Nick. Just a couple of nice comments, which I definitely appreciate, of course. And then lastly, here we had a question about PowerPoints and resources. So let me go back to fidelity.com. Let's give you some next steps and we'll get you folks out of here. Mark is about to wrap up in the afternoon market briefings coming up here shortly, anyways. So on fid.com, you can go to news and research. As always, go to the Learning Center. And once we're here, off to the left side, we're going to topics and then advanced trading technical indicator guide. I'm going to open up in a separate tab here. So anything that we discussed today is probably fair game underneath the volatility filter for indicators. We talked about ATR and contrasted to ATRP. So I'd encourage you to read those articles. Bollinger Band width versus Bollinger Bands. I briefly showed volatility index, VIX, in terms of mean reversion perspective. We talked briefly about standard deviation, what it is. We didn't get through some of the others as well, but these are the more commonly used volatility indicators. Like we're not talking about anything that's obscure by any means, right? If you go to a trading forum and say, oh, I use ATRP, people aren't going to scratch their head and be like, what's this guy talking about? Like they'll know what you're talking about, okay? We wouldn't lead you astray. So I would definitely encourage you to take a look at some of these articles and these resources. In addition to that, if you search what is it? I think it's technical indicator. There should be a recorded webinar. That's not, of course, this exact session, but it's going to be relatively close. Nick,
Yeah,
do
there
you
are a
know what
couple
it
of them on
is?
this. The I think it's
Here's one of them. This might be another one here. Excuse me, folks. I apologize. Our Learning Center
I'll
team recently
always
changed
do like
this.
if you like type in understanding indicators and technical analysis, which is the title of the slides that we're using. That I think that will pull it up as well.
Let me try that, Nick, here. Again, sorry, folks. You're seeing us kind of figure this out live. That's how you know it's real, right? Not recorded. What is it? Understanding
Understanding indicators.
indicators. All right, let's try this. And then maybe sort by video. Let's check that. See if it pops up. Yeah, I mean, there's some stuff in here. So this is the one I already had up, charting with newly available technical indicators and technical analysis for volatile times. Those are the two I had in mind. If you just search for those folks, so technical analysis and search by videos, or technical indicators, I should say, or understanding indicators, a lot of different ways, right? Hopefully we can see that. Search by video or filter by that. There's a few recorded webinars here that's going to talk about a number of indicators and volatility specifically. So I would say check out the website articles and check these out for homework and some additional resources moving forward. If anyone tries to filter by webinar, for whatever reason, I don't know why they made this decision, but nothing really comes up, even if it was a webinar. So I would definitely encourage you to search by video And even though it is a webinar, it'll be under video. Confusing, right? We love to give you a hard time
They're
sometimes.
all videos now. Yeah.
They're all videos. Yeah, webinars are video, videos are video. It is what it is. Um, yeah, folks. So there it is right there. And then lastly, I'll pull up this calendar here. Nick, I'll just make a brief announcement. Of course, some clients have already heard this as well. I did take a new position here within Fidelity, so I'm still staying at Fidelity, but I won't be part of the trading strategy desk as of this Friday. That would be my last day Friday. So next week I start a job with the educational content team. Funny enough, they do a lot of what we do, but it's all written education and planning for like series and webinars and content scripts, stuff like that. So I'll be moving over there after this week. So
So,
why do I
so
bring
now
it
if
up?
you, yeah, now if you find a typo on our technical indicator guide,
Yeah.
we can complain to Chase about it.
Yeah, if you're reading a trading article, hopefully in a couple months' time, it'll be written by me and sort of directed and all that stuff. So I say that not to make it about myself, but I see some clients here in the Q&A, Nick, saying, "Hey, can they reach out to me before I leave the team?" Absolutely. If you have the link already, folks, for a team, you're welcome to make an appointment. If you don't, send me your email or leave it as a comment in the Q&A, and I'll do my best to try to find a time. I still have a few free slots, although it's kind of filling up here in this last week, but I will do my very, very best. If you're looking to have a one-on-one, if not, no problem. I just take it personally. I'll cry about it later. No problem. But yeah, I want to thank everybody, of course, for attending this session. I look forward to the one-on-ones with anybody else in the near future. And I've got a few more sessions left here, Nick. No time for tears just yet. Maybe Friday or
I know,
Thursday to be a cry fest. But for now, uh, it is what it is, right?
I,
Business as
I know
usual.
we're putting together the August schedule. We're joking about that. We need to have Chase on
Yeah.
all 5 sessions for Thursday and Friday to kind of send him off.
Yep, absolutely. In fact, I'm looking at my own personal calendar, Nick. It looks like my last session will be from a group perspective Thursday. So this charting with Chase session on Thursday. So if you can make it, awesome. I'd love to see you. If not, no problem whatsoever. And I'll probably make some guest appearances as well. I plan to come back to the team and do a presentation here or there. I think that'd be pretty fun. So it's not goodbye. It's till next time. No doubt about it. But until then, take care. Nick, good to see you as always, man. Have a good weekend or
Take care,
beginning of the
everyone,
week, I should
and
say.
till next time.
All right, take care.